Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for September 30th, 2018. Market breadth. With this past week's market fractional advance, our bull-bear point and figure ratio at 0.69 fell from 0.77 last week. The total count of securities in bullish or bearish patterns decreased 2% to 3,242. The count of bearish stocks increased 3%, while the count of stocks in bullish patterns decreased 8%. The Pirls P&F market breadth summary chart shows us a market now 4 weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq-McClellan Summation Index, fell 76 points for the 12th decline in 16 weeks. At a positive 26.47 points, it continues below all 8 tops above plus 100 in the last 30 months, and it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in accumulation mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum. The CCI 20 daily, now at a positive 76.82, rose from a positive 17.80 last week. At Tuesday 9/25 close, the CCI 20 daily formed a new zero-line reject long entry trade with a pivot within the plus or minus 50 range. We will continue following the result of this trade simulation in next week's commentary. In Woody's CCI trading system, 6 consecutive bars above or below 0 are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 126 weeks ago, while the daily CCI 20 began a Woody's uptrend 11 weeks ago. The CCI 20 weekly rose to a positive 104.32 from 98.59 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: oil, oil services, S&P retail, and some tech on the top. REITs and KBW Bank on the bottom. Bullish: S&P retail has left the bottom 5 and entered the top 5. CompTech has entered the top 5. Disk drives has left the bottom 5. Gold and silver has left the top 5. Bearish KBW Bank continues in the bottom 5. Oil continues in the top 5. Oil services has entered the top 5. Focus this week from www.ineteconomics.org. Why Dodd-Frank is a Shell Game for Banks, by Edward Kane. The following are some key points and pointed illustrations. 10 years after the crisis, the financial regulation leaves taxpayers holding the bag for banks' safety net. Regulation is best understood as a dynamic game of action and response, in which either regulators or regulatees may make a move at any time. In this game, regulatees tend to make more moves in pursuit of safety net subsidies than regulators can or do make to stop them. Moreover, regulatee moves tend to be faster and more creative, and to have less transparent consequences than the moves that regulators make. In modern times, banking crises have occurred when managers pursued concentrated risks that made their institutions increasingly vulnerable, but generated a series of substantial and long-lasting safety net subsidies until things finally went south. As I explore in my new INET working paper, such subsidies can prove long-lasting because the regulatory cultures of almost every country in the world today embrace, in one form or another, 3 strategic elements. 1. Politically directed subsidies to selected borrowers. The policy framework either explicitly requires or implicitly rewards institutions for making credit available to favored classes of borrowers at a subsidized interest rate. In recent crises, subsidized loans to homeowners played this role. However, the next crisis may feature loans to current and former students, pension funds, and state and local entities. 2. Subsidies to bank risk-taking. The policy framework commits government officials to offer on subsidized terms explicit and/or implicit, that is, conjectural, guarantees of repayment to banks' depositors and other kinds of counterparties engaging in complex forms of bank deal-making. 3. Defective monitoring and control of the subsidies. The contracting and accounting frameworks used by banks and government officials leave no paper trail. They are careful not to make anyone directly accountable for reporting or controlling the size of these subsidies in a conscientious or timely fashion. Taken together, the first 2 elements of the subsidization strategy invite commercial and investment banks to use the safety net to extract wealth surreptitiously from ordinary taxpayers. To keep subsidy-generating leverage high, the bulk of the subsidies banks receive are promptly paid out to top managers and to shareholders in the form of dividends and share repurchases. The result is shifted forward and backward, mostly to large creditors and politically favored borrowers, but a few dollars might be reserved for like-minded academic researchers and community groups. Favored borrowers are primarily blocks of voters, such as would-be homeowners, regularly courted by candidates for political office and traditional sources of outsized campaign support, such as bankers, landlords, builders, and realtors. The third piece of the framework minimizes regulators' exposure to blame when things go wrong. Gaps in the reporting system make it all but impossible for outsiders, particularly the press, to hold supervisors culpable for violating their ethical duties. These gaps prevent outsiders from understanding, let alone monitoring, the true costs and risks generated by the first 2 strategies. Few politicians and regulators want to subject the intersectoral flow of net regulatory benefits to informed and timely debate. This weakness in accountability exists because the press is often content with regurgitating the content of agency press releases and because accounting systems do not report the value of regulatory benefits as a separate item for banks and other parties that receive them. But hasn't the Dodd-Frank Act changed all this? The Dodd-Frank Act is best understood as a collection of policy measures designed to weave its way respectfully through different industry lobbyists' self-absolving alternative theories of the crisis to incorporate a sometimes lame treatment of the forces featured in each of them. These subsidies are hidden in the systems used: 1. To finance housing investments on the one hand, and 2. To finance payouts from the U.S. financial safety net on the other. In turn, the norms that make these subsidies durable are rooted in a generalized breakdown in professional ethics that the DFA does not treat at all. Focusing only on bank capital is a loser's game. It is fiendishly difficult for incentive-conflicted leaders of regulatory agencies to control firms that capital markets perceive to be macroeconomically, politically, or administratively too difficult to close and unwind. For such megabanks, the Basel approach of setting capital requirements only against what have become well understood and easily measurable exposures is massively inadequate. As always, an unreformed and elitist justice system continues to grant mega bankers near impunity for forcing the safety net, rather than their stockholders, to finance their firm's deepest risk exposures. Dialectical process I have outlined explains that increased capital requirements and incentive-conflicted stress tests cannot keep taxpayers' loss exposure in megabanks under control for long. Whatever the level of capital requirements, the taxpayer's stake increases when and as, notice I do not say if, bankers find new and better ways to hide leverage, tail risk, and distress from their supervisors. In principle, stress tests can compensate for some of the weakness in the design and implementation of capital requirements. But in practice, stress tests focus narrowly on only a few very specific scenarios. In any case, it looks as if regulators have stopped using these tests to assess the volatility of taxpayers' stake in large banks. Beginning this year, the Fed appears to have repurposed the tests as a way to provide supervisory cover for captured regulators to permit the megabanks to use share buybacks and dividends to pay out enough of their accumulated profits to drive their safety net subsidies up again. Most commentators argue that U.S. megabanks are safer now than they were in 2007-2008. But that is a superficial test. A more important and unasked question is, for how long? Figure 1 tells us that the process of rebuilding megabanks' leverage-driven tail risk by means of dividends and stock buybacks is already getting underway. Equally worrisome, bank information systems do not even try to track taxpayers' stake in banking firms, and the regulatory, supervisory, and justice systems remain focused on disciplining banks rather than bankers. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Sand to Pearls Stock Market Commentary, I'm Cynthia Pearl, hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.